It starts with a tap, a green button, the word buy. No commission, no fee, just freedom. Or so you thought. What if I told you that every time you trade on a free investing app, someone else is watching? Not just watching, but buying your intention milliseconds before it hits the market. Because behind that clean interface, behind the fireworks and emojis, there's a quiet transaction you never approved. A billion-dollar marketplace where your orders are the product, and someone is profiting from you not knowing. They call it payment for order flow. It sounds harmless, technical, boring even, but it changed the way Wall Street works, and it turned democratized investing into a silent form of control. Today, you'll see how a mechanism hidden in plain sight is being used to front-run the hopes of retail investors, how market makers became richer than the banks they serve, and why the most powerful firms in finance pay to see your trades before they happen. Because the system isn't broken. It was designed this way. And once you see it, you can't unsee it. You've heard the pitch before. No commissions, no fees, trade anytime, anywhere. It sounds like a revolution, but if no one's charging you, who's paying for the platform that just handled your $40 trade like it was a $4 million one? Here's the first crack in the mirror. Every time you place a trade on a free app, your order doesn't go directly to the market. It takes a detour. That detour is where the real money is made. In 2020 alone, Robinhood earned over $687 million, not from you, but from selling your orders to firms like Citadel Securities, Virtue Financial, and 2 Sigma. These firms pay to receive your trades. Why? Because your order is data, and in the right hands, it's weaponized insight. Let's break it down. When you hit buy, your order is bundled with thousands of others and routed to a high-frequency trading firm. They're called market makers, but don't let the name fool you. They're not just making the market, they're owning the information. They know what retail traders are buying, when, and in what volume. And that knowledge, before it becomes price action, is pure gold. So they pay the app to see it first. They buy the flow. Payment for order flow. And the app? It gets to keep saying commission-free, but it just handed over your intention to a middleman whose job is to profit from it. You think you're placing an order directly into the market, but you're actually entering a silent auction where your data is the prize. Now here's the twist. These firms are legally obligated to give you the best execution available. That phrase appears in almost every PFOF disclosure. But what does best really mean? Is it the absolute best price available anywhere? Or just a price that's technically within the spread? Because if they can fill your order for $10.02 instead of $10.00 and pocket the difference without technically violating anything, they will. They already do. And since they pay the platforms for access, the platforms have every reason to keep feeding them more orders, more flow, more you. Robinhood once earned over 75% of its revenue from selling order flow. Let that sink in. The app didn't make money from you making money. It made money from you showing up. Your loyalty, monetized. Your trades, repurposed. Your free experience, anything but. And you wouldn't know, because it's all invisible. You see charts, colors, gains and losses. But behind the screen, in quiet rooms with cold lighting, trades are being dissected, timed, and optimized for someone else's gain. Still, the question remains, Who are these firms paying for your flow? And what are they really doing with it? That's where we go next, because if your orders are being sold, we need to meet the ones buying them. And what you'll see in that room will change the way you look at free forever. So your order didn't go straight to the market. It was intercepted, redirected, monetized. But by who? Let's open that door. In 2021, one name cleared more than 47% of all U.S. retail volume. Not a bank, not an exchange, a firm most retail traders had never even heard of, Citadel Securities. They don't run ads. They don't need your approval because they're not competing for your trust. They're buying your behavior. Citadel is what's known as a market maker, but in reality, it's a market mover, armed with near-total visibility over retail flow. Alongside Citadel, there's Virtu Financial, 2 Sigma, Susquehanna, a quiet syndicate of algorithmic giants. These are not brokers. They are buyers of your orders, your patterns, your habits. When Robinhood or any other zero-commission app sells your order flow, it's often Citadel on the other end writing the check. They're not doing this out of generosity. They want to see the trade before the market sees it. Milliseconds matter. Because if Citadel knows that 50,000 retail investors are about to buy Tesla, they can adjust their positions, hedge, or profit before the wave hits. This isn't illegal. It's strategic. It's the modern version of sitting at the poker table with a mirror behind your opponent's cards. And the system allows it because Citadel provides liquidity. Liquidity sounds noble, but let's decode that. Imagine this. You're buying a stock at $20.01. Citadel already owns it at $20.00. They sell it to you instantly, pocketing the 0.01 difference. Do that a few hundred million times a day, you build an empire. In fact, Citadel Securities made $6.7 billion in revenue in 2020 alone, not from investments, from being the middleman. The beauty of this model, the house never risks much, because it knows what everyone else is doing first. Virtu follows a similar logic. Armed with hyperspeed data centers, they don't just execute your order. They analyze it, they compare it, they use it. In the world of high-frequency trading, knowledge isn't just power, it's prediction. Every swipe on your app feeds a system that's already calculating the next move before you make it. This isn't about manipulation. It's about information asymmetry. They see the whole board. You only see your next move. Still think your trade is yours? The platforms call them execution partners. The filings call it order routing optimization. But let's call it what it really is. Surveillance capitalism with a Wall Street twist. Now here's the part few ever consider. If these firms are paying so much to buy your trades, what's the real value they're extracting from them? And more importantly, are they just reacting to your trades or shaping the market before you even place them? Because once the middleman sees the game from above, he stops playing fair. He starts writing the rules. And in the next chapter, we'll look at exactly how they turn your trades into microscopic profits without you ever seeing the cost. Citadel sees your trade. Virtu analyzes it. But how exactly do they profit from it without touching your wallet? It happens in a space so small it feels harmless. Just a penny, sometimes less. But that's all it takes to turn your free trade into someone else's payday. This is the game of the spread. Let's say a stock is quoted at $10 bid and $10.02 ask. That means someone's willing to buy at 10 and someone's willing to sell at 10.02. That 2-cent difference? That's the spread. Now imagine you hit buy. The trading app tells you, done, you got it for 10.01, best available price. You smile. You feel smart, efficient. But here's what just happened behind the curtain. The market maker, say Citadel, already owned that stock at 10. They sold it to you for 10.01. They let you save a penny from the ask, while they guaranteed themselves a penny over what they paid. You got a better price than 10.02, but not the best price that existed, because that penny, it wasn't spared, it was redirected. Multiply that by hundreds of millions of trades per day, and what looks like crumbs becomes a feast. Now here's the clever part. Market makers are required to give you what's called price improvement, but the regulation doesn't define how much improvement, just that it's better than the national best bid or offer. So if they improve your order by 0.001 cents, they're compliant, and they're still collecting the rest of the spread for themselves. It's not theft, it's optimization. And it works beautifully because you never see the spread. You see a confetti animation and a message, you just bought 5 shares. But behind that celebration, algorithms just dissected your move down to the microsecond. Even worse, the size of your order can affect the spread itself. Retail investors, often trading in small quantities, create predictable microflows. And market makers use those flows to anticipate momentum, rebalance inventory, and fine-tune their margins. It's not just about taking your penny. It's about engineering a system of pennies that always flows toward them. 1 penny at a time, 1 trade at a time, billions of times. And the apps love it, because the better the spread extraction, the more valuable your flow becomes, and the more they can sell it. So when you thought you were just buying stock, you were part of an invisible equation designed to feed someone else's edge. Now pause. Ask yourself, if they can do this much with 1 order, what happens when the crowd moves together? What happens when millions of retail traders flood into the same name, the same day, at the same time? That's when the spread becomes unstable, and the system reveals its true face. In the next chapter, we'll revisit a moment when it all cracked, live, global, unstoppable, until someone hit pause. You remember where you were. January 2021. GameStop, AMC, Nokia. Stocks no one cared about, suddenly exploding. Reddit boards turned into war rooms, Twitter threads into strategy guides. It felt like retail investors were finally beating Wall Street at its own game. But behind the scenes, the system was shaking. Because when millions of orders flooded in, tiny, individual, erratic, the elegant machinery of spread extraction and order flow routing began to jam. The algorithms couldn't predict the chaos. The market makers couldn't price it fast enough, and the platforms couldn't control it. Robinhood, the app that promised financial freedom to all, suddenly halted trading on multiple stocks. No warning, no vote, just you can sell, but you can't buy. The fallout was immediate. GameStop plummeted. Users screamed. Congress took notice. But what triggered the freeze? Robinhood blamed collateral requirements from its clearinghouse, said it needed to protect the firm from volatility. Technically true, but there was more. Robinhood's largest revenue source at the time? Citadel Securities, the same Citadel that handled more than half of all U.S. retail trades, the same Citadel that had a vested interest in stabilizing the system. Even though Citadel and Robinhood denied any coordination, the timeline raised questions. Citadel's hedge fund division had just bailed out Melvin Capital, the firm shorting GameStop into the ground. So let's pause. Retail traders caused a short squeeze that nearly crushed a major fund. Citadel bailed out that fund. Citadel also bought order flow from Robinhood. Robinhood froze trading. Coincidence? Maybe. But here's what we know. The moment the system stopped working for them, they stopped letting it work for you. In the name of risk management, Robinhood took away the very action that made its users feel powerful. And the irony? It was the very same mechanism, payment for order flow, that helped fuel the frenzy. By routing billions of trades to market makers who profited from spread arbitrage, Robinhood amplified the speed and intensity of the retail surge. But when the feedback loop became too loud, too unpredictable, the button got pulled. Not by the user, by the system. And suddenly, all that talk of democratization, decentralization, and disruption melted into silence. The real message was clear. You can play, but only if the house is still winning. And if it's not, well, then maybe your freedom has a circuit breaker. But what if this wasn't just about GameStop? What if your behavior, your timing, even your instincts were already being used to shape the very system you thought you were challenging? What if the game was never about who trades faster, but who sees the next move before it happens? Because the final layer of this puzzle isn't about execution, it's about influence. And in the last chapter, we'll ask, if your order is being sold and your edge is being copied, are you still the trader or just the signal? By now, you've seen the path. Your trade is routed, your price is shaped, your access can be revoked. But there's one last question most never ask. What if your decision wasn't just being observed, but influenced? Let's take a step back. Free training apps are designed to feel empowering. Clean design, gamified experiences, instant feedback. Every swipe, tap, and emoji makes it feel like you're in control. But behind the interface, your behavior is being tracked in real time. What stocks do you browse? How long do you hesitate before placing a trade? When do you panic? When do you chase? All of this data is captured and fed into systems far more powerful than your app. Because market makers don't just see what you're doing, they model what you're going to do next. And not in the abstract. We're talking predictive behavior algorithms trained on billions of trades, able to forecast patterns with eerie precision. Not just price direction, but sentiment waves, retail surges, FOMO spirals, panic sells. What was once a user interface is now a data farm. And what you believed was your strategy might be something the system nudged you into. Think about it. If your trade gets front-run by a faster player, if your app is subtly guiding you toward trending names, if your order feeds a model that repositions before you blink, are you still making choices, or are you being used to reinforce a feedback loop? Here's where it gets darker. Some market makers run both sides of the equation. They process your trade, then immediately hedge or arbitrage based on what your flow predicts. You show up with $500 in a dream. They show up with an army of code, and your next 5 moves already priced in. This is no longer about markets. It's about information warfare. They don't need to manipulate the price. They just need to be early to your idea. And by the time you realize the trend, they're already exiting it. That's not trading. That's orchestration. And the craziest part? You helped build it. Every free trade, every click, every decision fed the machine. A machine that doesn't sleep, doesn't guess, doesn't care. It just calculates. So the final question isn't, what's the best stock to buy? It's, what part of your behavior is the market already monetizing? And if you knew that your every move was predicted, packaged, and sold, would you still call it freedom? You came for free trades. What you found was a system. A system where your intention is currency, your hesitation is signal, and your freedom was always part of someone else's strategy. They told you there were no commissions, but the real price was invisibility. Your trades rerouted, your instincts monetized, your edge neutralized. So the next time you open that app, ask yourself, who's really on the other side of this trade? Because in the markets, nothing is ever truly free. And if you didn't pay with dollars, you paid with data. If this opened your eyes, if you felt like you just peeked behind a curtain not meant to be touched, then don't keep it to yourself. Subscribe, leave a like, and share this with someone who still thinks free means fair. There's more to uncover, and next time, we go even deeper.